Imagine a world where an economic war with the United States actually helps Europe. Sounds crazy, right? Well, that's exactly what Christine Lagarde, president of the European Central Bank, seems to be suggesting. According to Lagarde, a U.S. trade war could force Europe to reinvest in itself, making the continent more self-sufficient and less dependent on American goods, services, and technology. So, is she right? Could an economic clash with the U.S. be exactly what Europe needs to rebuild its industries? Or is this a dangerous gamble that could backfire? Let's break it all down. What did Lagarde actually say? Christine Lagarde is no stranger to economic power plays. As the head of the European Central Bank, ECB, she knows exactly how global markets react to trade conflicts. Her argument is simple. If the U.S. starts a trade war by imposing tariffs or cutting off access to American markets, Europe would be forced to invest more internally. Instead of relying on American tech, energy, and finance, Europe would develop its own alternatives. This would ultimately make the European economy stronger, more independent, and more resilient. It's a bold take. But let's ask the real question. Does this strategy actually work? How a trade war could force Europe to invest in itself. To understand Lagarde's logic, we have to look at how Europe and the U.S. are economically intertwined. Right now, Europe relies heavily on the U.S. for technology. American giants like Apple, Google, and Microsoft dominate Europe's digital landscape. Energy. After cutting ties with Russia, Europe has turned to the U.S. for LNG, liquefied natural gas. Finance. The U.S. dollar and Wall Street play a massive role in European banking and investment. A U.S. trade war could cut off access to these key resources, forcing Europe to build its own versions. For example, instead of relying on Google and Microsoft, Europe could boost homegrown tech companies. Instead of depending on U.S. gas, Europe could double down on nuclear, renewables, and domestic energy production. Instead of using American-dominated financial systems, Europe could strengthen the euro's role in global trade. This sounds good in theory. But what about the risks? The danger of backfiring. Can Europe handle the pressure? Here's the catch. Building self-sufficiency is not easy. It takes time, money, and a lot of pain before things improve. And Europe isn't exactly in the best position right now. 1. Economic fragility. Europe is already dealing with high inflation, slow growth, and energy crises. Cutting off U.S. trade could make things worse before they get better. 2. Lack of industrial investment. The EU has been losing ground to China and the U.S. in manufacturing and tech. Would European companies be able to scale up fast enough to replace American imports? Potential retaliation from the U.S. If Europe moves toward economic independence, the U.S. could hit back hard with more trade barriers. This could escalate into a full economic war, damaging both economies. Lagarde is betting that Europe can survive short-term pain for long-term gain. But is that a safe bet? Historical examples. Has this strategy worked before? Lagarde's thinking isn't new. Countries have tried this before, with mixed results. China's self-sufficiency strategy. After years of relying on the West, China has pushed aggressively to develop its own tech and industries. This has led to the rise of companies like Huawei, Alibaba, and BYD. But China's economy is still struggling with U.S. sanctions and trade restrictions. The U.S. in the early 20th century. In the early 1900s, America protected its industries with tariffs. This helped build the world's biggest manufacturing powerhouse. But it also led to international trade tensions. Japan's economic rise. Japan focused on self-reliance after WTO, investing heavily in technology and manufacturing. The result? Companies like Toyota, Sony, and Toshiba became global giants. But Japan also suffered from trade disputes with the U.S. Europe could follow a similar path, but it will have to navigate serious challenges. Who benefits if Europe goes it alone? If Lagarde is right and Europe does become more self-sufficient, who wins? European companies. More government investment means more opportunities for local businesses. Tech startups, energy firms, and manufacturers could thrive without U.S. competition. China and Russia. If Europe moves away from the U.S., it might get closer to China and Russia. China could become Europe's new tech and trade partner. Russia could see an opening to restore some energy ties. U.S. rivals in global trade. A weakened U.S.-Europe relationship could shift global trade power toward Asia. Countries like India, Brazil, and Turkey could gain more influence. Final thoughts. Is this a smart strategy? Christine Lagarde's vision is bold. Turn a trade war into an opportunity for European independence. But it's also risky. If Europe can't scale up quickly enough, the pain could outweigh the benefits. So, what do you think? Is Europe ready to break free from U.S. dependence, or is this just wishful thinking? Drop your thoughts in the comments below. And don't forget to like, subscribe, and hit the bell for more deep dives into global power plays.